Let's get right to the floor show. Joining me now, Northwestern Mutual Wealth Management Chief Investment Officer Brent Schutte. Brent, most stocks are up. I mean, yeah, they got Meta and Microsoft in trouble, but gold is up, silver is up. We thought, you know what, let's just throw in cannabis. I mean, weed is doing incredibly well. China stocks are moving higher. I think even Bitcoin is getting a boost. What do you think? Is there one thing that's lifting everything all at once right now?
I think economic growth has remained resilient. The labor market showed signs of stabilization after some signs of weakness towards the fourth quarter of last year. And the interest rate environment has remained relatively benign, despite the fact that oil prices have risen. You put that all together with earnings, and that's where investors are continuing to put money into stocks.
Earnings do look great. And listen, all you have to do is look at Caterpillar. Caterpillar, of course, is responsible for more than 400 points of this pretty significant 868-point gain. Does that make it a little less eye-popping in your mind? I mean, we've got NVIDIA and Microsoft at the bottom of the Dow heat map. NVIDIA's in a little bit of trouble, I think. Some of that has to do with the fact that Google had said that it is now selling direct to its customers the new custom chips that it has been making, and that would compete directly with NVIDIA. But, I mean, are you worried at all of anything that might, cause this bull stampede to stumble?
I think there's a lot of reasons for the bull stampede to possibly stumble. One, valuations. Two, the potential for rates to move higher because inflation has not been quelled yet. And it's going to be incredibly difficult for Kevin Warsh to actually cut rates. I think that is the biggest risk still, is just the inflation narrative, which we saw PC inflation come in at 3.2% on core year over year, which is the same level it was 2 years ago. We've made no progress. We're not the Fed's 2% target. We haven't been there for 5 years, and we're still talking about rate cuts. So I think that's a bigger risk. I think Caterpillar is indicative of something that we think is more powerful going forward, which is just the broadening beyond those 7 magnificent stocks into other parts of the market as AI becomes something that people use and companies use to increase their efficiency and productivity. And that's where you've seen AI adoption go from 23%, according to the RAMP AI index at the end of 2024, to now 50%. And this is where we think the market's going to continue to broaden in that AI trade, which was pretty much in those hyperscalers and chip makers, now moving to Caterpillar and other parts of the U.S. market, which I think is incredibly important pushing forward.
You know, we're looking at the Dow, we're looking at the S&P at a record, NASDAQ's close to a record, but it is the Russell 2000 that is up the most as far as percentages are concerned. This is a big bump here of 2% at the moment for the small and mid caps. You like this space, and it has done very well. What kind of legs does it have now?
I think quite a bit. I think there's always a question of, is there a disruption in the middle? Do we have some sort of a pullback if the Fed actually has to raise rates at some point? But if you look at relative valuations, they're at the same level relative to large caps that they were in 1999, 2000, which is the last time we had as narrow of market as we've had the last 2 or 3 years. That was driven by internet stocks. I don't know if we had a magnificent internet index back then, but we certainly had 5 to 10 stocks that were driving the stock market higher that were tied to the internet. And then it broadened out, and it brought in those small and mid cap companies that use the internet to reach their customers. And that's where I find the similar narrative going forward. And valuations are an intermediate term timing tool. And that's where I think this trade has legs for people who are interested in investing for the intermediate to longer term, not just the here and now.
It's funny. I remember we used to call them the internet blue chips, and they included, obviously Amazon and what was called Google back then. DoubleClick, remember that one? But yes, I think when you put these together, these 7, Mag 7, are just so stunningly massive when it comes to market cap, but also spend, that they tend to soak up so much of the oxygen. And it is interesting to see the Russell 2000 leap out ahead. Could you just tell me, I know you're kind of equal weight and value factor exposure focused, but your sector neutral approach, does that have anything to do with the fact that we have high oil? We don't know what headlines are coming out of the Middle East on any given moment.
More sector neutral, just to take away from that concentration risk. Look, those 10 stocks right now in the top of the S&P make up around 40% of the index. So if you're only investing in the S&P 500, 40% of whatever happens to you in the next year is determined by 10 stocks. That's not a risk that I want to take. That's not a risk that history's been kind to. A similar setup occurred back in the late 1990s, and we saw that people who concentrated in that area fall flat on their face. Maybe a prime example, Intel, one that made a new high last week. Prior high was made in 2000. It took 26 years to make a new high. The tech sector after 2000 took 17 years to make a new high. This is where at least concentration in the near term, from time to time, it can be something that is enticing for people. But the one thing that endures is diversification. And that's where I think there are opportunities outside of those 10 names that I think are growing. And that's where I think investors should be positioned going forward.
Year to date, Intel up 150%. Brent, great to see you. Thank you very much.
Thank you.